Bon, the market is crashing.
Dude, you're wearing shoes in the house. Hey, what are you, white? Hey, take them off.
The market is crashing. What do I do?
You should buy the dip.
But I did that the last time the market crashed. And now it's crashing even lower.
Yeah, but this time, I'm sure it's the very bottom.
That's what you told me last time too. Like, do you really know what you're talking about in finance?
Yeah. Of course I do. Of course I know what I'm doing.
What? Are you lying to me? Are you really lying to me? Do you not know what you're doing in finance?
Yes.
Gosh darn it, Bond. Like, what about my money?
Well, I said I wasn't a financial advisor. You really should have done your own research.
But what about my money?
Okay. Calm down and take a look at this. When the market is crashing, you should dollar cost average in.
Wait, isn't it better to wait till the market bottoms out and then buy it?
No. Here, have a seat. Do you know what dollar cost averaging is? Yeah, it's when you invest a certain amount of money every week or every month into the stock market, no matter what price it is. Yes, exactly. But if you wait till it bottoms out, you can buy it at a cheaper price. Are you saying that dollar cost averaging is better than buying it when it bottoms out? Yes. During the 2020 market crash, the S&P had its highest point on February 19th, 2020 at a price of $3,386. And then after a few weeks, it fell to its lowest point on March 23rd, 2020 with a price of $2,237. Now, that is a drop of a little bit over 33% over a period of 33 days. But it is only a period of 24 trading days. Okay, so 33 days of crashing, 24 days of actual trading. Yes. So, my spreadsheet is going to estimate how many shares of the S&P 500 you can get if you bought it with the dollar cost averaging versus buying it at the very bottom. So, if we plug in 3,386 for the price, and we say that it drops 8% per week, then we can see that at week number 5, the price is $2,231, which is pretty close to the lowest point. So let's say that you dollar cost average and you put in $100 a week. After 5 weeks, you would have put in $500 and you would have bought 0.191 shares of the S&P 500. At the very bottom, your $500 would be worth $426. You with me so far? Yeah. If you spent $100 a week, in 5 weeks, you would have spent $500 and you would have 0.0191 shares of the S&P 500. Yes. Okay, so let's say that instead of dollar cost averaging, you bought it at the very bottom of the market at a price of $2,237. You would have gotten 0.2235 shares of the S&P 500, which is more than what you got over here. Hey Bon, I'm kind of hungry. Do you have anything to eat? Oh, yeah. Babe, can you make me some food?
What did you say?
Can you make me some food, please? Thank you. I love you. There. Make sure you make it look good for the camera. Oh, good. Okay, so continuing on. The most you can make is 0.2235 shares of the S&P 500. Now, there are two main problems with that. Okay? The first problem is that what if you just don't buy it at the very bottom price? Okay? There's a very, very good chance that you could have bought it too early or bought it too late. Nah, I'll know when the market bottoms out. I'm pretty good at those things. Oh, really? Have you made money in the stock market from the 2020 market crash? Not really. I've been trading a lot of meme coins and meme stocks. Good market for that. Yeah, most people these days, they're just gambling with the stock market. Chances are most people are just way too afraid to buy it at the very bottom because at the very bottom is when there is the most fear. But if you wait too long, you might just miss the whole stock market crash. Problem number 2. The second problem is that you might not hold the shares for a very, very long time because chances are if you spend 500 to let's say 1,000 or whatever amount buying the dip, then there is a very, very good chance that you would just sell it after you make some profit. But what happens if the stock market keeps going up, up, up afterwards? For dollar cost averaging, you don't have to worry about that because if you just put your money in there and you plan to leave it for a very, very long time, it will work out in the end. Now, I need to say that if you are using this strategy, you should only invest in things that are going to be lasting for a very, very long time, like the S&P 500 or Bitcoin or Ethereum. Do not put it into hype stocks or hype coins. But don't you make videos on hype coins? Why are you telling me not to buy them? That's just to get views. I've always considered those coins to be kind of like gambling. Wait. Do you think that my videos are actually hyping up these coins? I don't really watch their videos. That's okay, don't worry about it. My wife doesn't watch them either. Knew it. But before we continue, this video is sponsored by I Trust Capital. I Trust Capital is a really good way to invest your cryptos for retirement. Its Roth IRA allows you to grow your crypto account tax-free. And it is ranked by Business Insider as the #1 crypto retirement account for low fees. Are you only saying this because they're paying you to say it? Oh yes. Yes, I am. But there are plenty of other companies that pay me a whole lot of money to promote their coins or their products or their services. But this is the second company that I've worked with over the past 5 months. Mainly because the other things, they are crap. Alright, fair enough. But do I get anything if I use your link to sign up? Why, yes, Christopher, you do. You can get $100 of free Bitcoin when you sign up with a minimum deposit of $2,500. Wait, $2,500? I don't have that kind of money. Do you have $2,500 invested in crypto? Yeah. Well, sell it all and buy it all back in I Trust Capital. I Trust Capital has a wide variety of coins from the stable and Bitcoin and Ethereum and all the way to the popular Mana, Axie Infinity, and Avalanche. Okay, I'm convinced. Use the link in the description below to get $100 of free Bitcoin and so that they can keep sponsoring me. Alright, so now I'm back to the video. So let's say that you can't buy it at the very bottom. Okay. At what price should you buy it at so that it would be the same as dollar cost averaging? Well, you probably don't know, so I did it for you. If you move over to the other side of the graph, you can see that if you put in $2,618 per share and you put in $500 for the initial amount, you can see that it has the same amount of shares as the one for dollar cost averaging. So that means that if you invest $500 at a price less than $2,618, then you would have made a profit. If you invest at a price higher than $2,618, then you would have been better off dollar cost averaging. Now, the big question is, how easy is it to buy it at a price less than $2,618? Well, to figure that out, it's pretty easy. You just go back to the chart, and if you start from the very bottom, you would see that it would take around 14 days. Actually, it's only 10 trading days. But also, there are 2 days where the trading is higher than $2,618. So that means that you only have around 8 days, around 8 days to buy the S&P 500 and spend $500 on those 8 days to make sure that you are doing better than dollar cost averaging. How much better? Who knows? Maybe 5%, maybe 6% or 10%. But if you guys really look at it, dollar cost averaging is only around 14% lower than if you bought it at the very bottom. 14%, which isn't too bad considering that the stock market dropped over 33%. But that means that you can only make at most 14 to 15% from buying at the very, very bottom. Chances are, if you don't get at the very bottom, you would probably only make around 7 to 8%. And that is only within that 8-day window. If you miss that 8-day window completely, which I did in that 2020 market crash, you would just be out of luck. That is why dollar cost averaging is the best method to use during a market crash.
Oh.
And I need to say this again. You should only be buying stocks or cryptos that you are going to be holding for a very long time. It doesn't work if you're planning to sell it over a period of time. That's just trading, okay? This is a buy and hold strategy. So only invest money that you can afford to invest and are willing to lose.
Does it work the same way for the crypto market?
Yeah, during Bitcoin's last mini crash, it took 100 days for Bitcoin to bottom out. But after it bottomed out, you only had a 14-day window where you could have made more money buying the dip than if you had dollar cost average.
So if the market is crashing, you should put more money in.
No, that is not what I'm saying. Okay? I'm saying to dollar cost average, put a fixed amount of money in a certain period of time over a long period of time. Dollar cost averaging. I am not telling you guys to put in more money during a crash. That is definitely not what I'm saying. Okay? Okay.
Are you only saying this so you won't get sued?
Yeah.